This conference will now be recorded.
Hello and welcome. I'm Jason Labrum, the founder and president of Intelligence Driven Advisors, and we wanted to take some time and present some thoughts to you about the current market volatility. We've done this before in times of market volatility. We'd like to get in front of you, our clients, and share with you what our thoughts are and what's going on, and also remind you about the philosophy that we've put forth and the discipline and investments, the way we manage your investment and your financial plan for you to make sure that we help you be comfortable and calm during these sometimes not comfortable and not calm, volatile times in the markets. This is why you've chosen to hire us as your advisor, and this is one of the things that we think is important to do, is to get back to basics and disciplines. When we have 3 days in a row so far where the market was down 1,000 points due to fears over coronavirus, and more importantly, over fears of what could happen to the economy and given the shutdown of different areas. So thank you for taking time to check this out. I'm going to be brief. I'm going to go through some slides. As we've promised, we will always present data when we have a reason to tell you what to do with your money and your life savings. We will have evidence. We will have data to back up and support what we're saying. As most of you could articulate probably by now, we have an investment philosophy that we believe in is passive. It's a passive investment philosophy, but we actively manage that, and we actively manage the entire process, everything from your financial plan and customizing your investment strategy to your plan, to how we rebalance portfolios, execute tax loss harvesting, how we trim profits when things are going up, and add to positions that are down. So we're constantly and continuously working on the portfolios and your investment strategy to make sure it's great and it works for you. But it doesn't change the fact that sometimes we get a little unnerved as investors, and this is where we come in to help you and remind you of the basics of what we're doing. So I'm going to share a few slides today that I think are on point to this particular epidemic, now called a pandemic, that we're dealing with, and hopefully this will give you a lot of confidence and a lot of comfort as to what we're doing for you. So thank you. First of all, our friends at First Trust provided some of this research and data, so we thank them for their contribution. But this is not new. I know the particular virus, coronavirus, is new, but it's not new. We've had scares before with not only viruses and epidemics and pandemics, but we've had worse things. We've had credit crises and market collapses and major institutions going broke, the entire banking system on the verge of collapse. So we've had things. The flavor is different, but the fact that the media is sensationalizing, maybe they're sensationalizing it, we hope they are, but they certainly get paid by having ratings and people watching, so they don't tend to downplay what's going on. If anything, we think they sensationalize it a bit, and it can make us nervous, so that's why we're here for you. But if we look back and looking at the screen, you can probably see my mouse and what's happening on, but we go back to even 1981 or two, where we had AIDS and HIV. This was an epidemic that affected the stock market temporarily. We had plague, we had SARS, bird flu, H1N1, dengue fever, measles, Ebola, cholera, we had Zika. So we've had more than, when I got this slide, I thought it would be less, but look at all these different scenarios where we've had something similar happen. And more importantly, if we look over here to the right side of the screen, you'll see that the average return 6 months after that epidemic happened, or that big event occurred, the market was up on average 8.8%. Likewise, 12 months later, the market was up on average 13.6%. These things tend to rock the markets because they're new news and they're new information, so they change the price of things. But then once the dust settles, the markets tend to recover, and actually recover quite well from one of these. So we don't think this is going to be different. We don't think that global capitalism ceases to exist and that companies stop producing goods and services. This could be nasty, could go on for a while, and maybe this is the trigger that starts that next recession or serious bear market. And if it does, we won't know until it's already happened. So what we do is stick to our discipline, stick to our philosophy, and I think we'll do very well because stocks reward you for owning them over time. Bonds reward you for owning them over time and making emotional reactions to headlines almost always does not work. But besides just epidemics and viruses and pandemics, so you can see that going from 2008 to 2019, and we have this presentation if you're interested, going back to 1928, but all big events and big things that would possibly take you out of investing in the market. And you can see that during this time, the market delivers, and the S&P 500 is what we're talking about here, which really isn't the market, as some of you have heard me say. The market is all stocks and all bonds, but this segment of the market, the S&P 500, goes up 9% over a time where $10,000 invested turns to $28,000, where there was a plethora of reasons why you would not be invested, or you would think it's different this time, or something's new and going to change. What I find probably most interesting is when we look back over the last 10 years, it's been a great run, right? We've gone up, it's been pretty consistent, not a lot of volatility, but volatility is something that is normal and natural, and it is part of being an investor. Heck, that is one of the reasons you get rewards of 10% for equities on average over time, 5% or 4% for bonds on average over time. It's because you have to endure something. It's not easy. Not everybody can do it. So the volatility is one of the things that allows us to have those returns. If you look at the slide here on the screen, going back to 1980, the top number shows where the market ended up for the year. But the orange number and the bottom number shows where at one point during the year the market was down. And you can see that even starting in 80, the market ended up positive 26%, but at one point was down 17. The next year, the market was down 18, ended up down 10. At one point, the following year, the market was down 17 and ended up a positive 15. This is kind of a consistent theme, right? Most years, markets go up. Some years they go down. Sometimes they go down a couple of years in a row. Over the average since 1980, there's been a peak to trough, a downturn of at least 14% on average. So the fact that we've gone through 9% in 3 days is, yes, an alarm, but it isn't different than what we've experienced before. It's not different than what we expected. And we've been working hard every day to make sure that when things do really well, we trim profits. When things aren't doing well, we add to it, making sure that our investment philosophy is right, putting our investment philosophy in our portfolios in front of people like BlackRock and Rob Arnett and Research Affiliates and PIMCO, the biggest and most well-researched firms in the world and investment companies in the world, and we ask them to break our investment philosophy. We say, find what's wrong. So a lot of people have asked, what are you doing because of this event? And I said, what we're doing because of this event, we've been doing all along. We never stop working. Whether the markets are good or bad, we're constantly striving to make sure that we have the best portfolios for you, and also that we're able to help you make the best decisions as an investor and have the best investment philosophy that you can stick to. So short video, I think some slides that are relevant, they'll be included in the link here so you can look at those slides on your own at your own pace. But we wanted to get in front of you. I'm speaking on behalf of all of the advisors here at Intelligence Driven Advisors and all of the staff. We care about you, we care about how you feel, and we want you to know that we're working hard, and we will make sure that your plan matches the right portfolio, and we will help you adhere to the discipline that rewards long-term investors. And we will help you not make the behavioral blunders that most investors make, because we don't want that to destroy your long-term returns. We thank you so much for the opportunity to serve you. We are very gracious of your continued business trust and confidence. We don't take it lightly, and we thank you so much. If you have any questions, this is the time. If you're nervous, this is the time to revisit your plan, and this is the time to call us. You are not an interruption to our work. You are the reason we have work, and we thank you for that, and we want to be here for you. So please don't hesitate to call if you want to visit more about this and your specific individualized plan. But with that, I think you have reason to believe it's not different this time. The markets are not going to just fall apart and all your money is going to go away. It just doesn't work like that. We're too diversified. We have too good of asset allocation. And if we stick to our principles, we'll do great over time, and you'll be able to achieve your best financial life with us at IDA as we help you pursue better. Thank you so much for listening. Give us a call if you have any further questions. Talk soon.